Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest updates. Well, two major reports are out from the World Gold Council. One, of course, called Gold Demand Trends Q2 2024. And we have another report, a little bit about the election called Ballots to Bullion. Now, in the second quarter of 2024, global gold demand, including OTC investment, increased by 4% compared to the same period last year. This is driven by increased central bank purchases. Of course, we will unpack this. Now, it comes at a time when the U.S. is navigating significant economic and political turbulence. President Biden's recent decision to end his re-election campaign has added a new layer of uncertainty. And the race between Kamala Harris and Donald Trump is intensifying as the upcoming election looms. Moreover, the World Gold Council's latest findings reveal that geopolitical risks and economic policies, rather than election outcomes, have historically influenced gold prices more significantly. Well, with the FOMC meeting just around the corner, investors are keenly watching how potential changes in monetary policy might impact the markets. And of course, to help us unpack these two reports, we welcome back our friend Joe Cavatoni. He's the market strategist for North America at the World Gold Council. Joe, welcome back to the show. Great to see you.
Great to be back, Jeremy. Thanks for having me.
So we got these two reports out, certainly a lot to unpack. I mean, we talked a little bit about the latest gold demand trends Q2 2024 report, and it shows a 4% increase in global gold demand compared to Q2 2023, despite OTC demand down a little bit and jewelry demand down too. Talk us through this. Talk us through this report. What's driving the surge? And give us some insights into these numbers, if you could.
Great. And I'll tell you, the second quarter report does an amazing job of highlighting something we often talk to quite a bit, which is gold is global and gold has different use cases. And you need to understand all of them when you're trying to understand the forward trajectory of the price. So what we're getting now is a shift away from price being predominantly controlled and driven by the Eastern markets. When prices get higher, the consumer, like the jewelry market, tend to step back, and that's what we've seen in both China and India. But we're also seeing the emergence of the Western catalyst for change and investors coming back to the table. The ETF flows are showing a bit of that. So ultimately, this move back from alternatives to gold by the Western investors. So you're seeing this push and pull and this new dynamic developing over the second quarter period. And actually, it's going to be something we're going to continue to watch. Now, you also hit on couple of key facts. Central banks are still at the cornerstone of a lot of the buying, even with the slowdown from China. And now we're getting into what we would characterize as probably a unique election with a lot of emotion that's developing. That's going to likely lead to more emotion, maybe even more volatility around the gold price.
Yeah, talk to me a little bit. We were talking about the over-the-counter price here, talking about the demand, and I want to get into that and unpack it a little bit more for the audience because, we look at the report, gold demand excluding OTCs was down by 6%, but overall, obviously, a lot of demand for gold. We look at central banks, we look at jewelry. Talk to me a little bit about the nitty-gritty here, Joe.
So what we're seeing in the OTC space is actually a really interesting dynamic. So we can track and trace quite a few different types of gold and how it gets consumed by the different categories. But when it comes to physical gold, bars in particular, that's an area that isn't as clear or easy for us to track. But we do know the types of gold that gets consumed there. Large bar format, those 400-ounce bars or kilo bars, and those bars that actually get purchased as investment and large-scale investment particularly. So when we hear about this number being large, there are certain categories of investors that we know are active. Large family offices, private banking, other institutions, maybe even a sovereign wealth fund that doesn't have the requirement to report like a central bank does. But those types of institutions being very active in picking up gold. It's to be understood as an element of gold that we don't have total transparency on, but we know exists. And ultimately, it's likely going into the hands of those that are putting it to work as an investment. Now, on the flip side, with jewelry, totally clear what we can see there. And again, the price dynamic there, when prices go high, the pure consumption behavior from the jewelry side tends to show weakness. You might recall that in first quarter, we were a bit surprised to the upside with China. That's starting to show the true signs of what we would expect from a consumer. higher prices, less likely to go about making a purchase really on that consumption side, that real jewelry end of the spectrum. They gravitate more towards investment.
Okay, we were talking a little bit about the central bank buying, and you mentioned China. Even though they seem to at least report that they paused there for a moment, we saw the market dip and have a small pullback, and then it came back. I mean, it's been very resilient. I mean, buying on the central bank was 6% higher year to year. We talked a little bit about that impact on jewelry consumption. Talk to me if you think the trends are going to continue into Q3 and Q4 here.
Well, we definitely see, in particular on the back of our central bank survey that we just completed earlier in the year, a very strong case for, in particular, emerging market central banks to continue to be at the table. Highly publicized moment for China around May and June around not adding to their gold reserves through officially reported channels. What we can say, though, is that the central bank in Poland, Turkey, other markets, those that have also been contributing to this 14-year trend, continuing to be active. We'd say that, again, what they're highlighting in the report, what they're telling us are their motivating factors, aren't just one factor. It's a concern around inflation. It's a concern around portfolio diversification, the need for liquidity. And actually, that's why they're adding it and continue to add the asset to their portfolio versus just being worried about one geopolitical issue or one conflict away from seizure of our assets, et cetera. So it's an element, but the real driver there is fundamental portfolio diversification that's needed, and that's why they're going to continue to be a strong supporter of price. So if they're slowing, it's likely slowing part of their reserve policies, but the case for the addition of gold to the portfolio still remains very, very strong amongst that community.
Okay, Joe, when you and I typically talk about central banks, we talk a little bit about India, a little bit about Turkey, lots about China. We look towards India, and it looks like demand is growing despite the prices of gold. And we've seen those cracks with the retail consumers there. Prices go up, maybe they don't spend as much. Talk to me a little bit about this. It's a surprising stat.
Well, I think it's actually a very interesting stat, and I think it's actually one that we're going to keep a very close eye on, in particular on the back of the tariff for gold being reduced by the Indian government just within the last week. And it's actually a very interesting sign for sure. So while consumption in jewelry, as expected with higher prices, is down a bit, what we are expecting to see is, like we've seen throughout the course of the Asian markets over the last year and a half to 2 years, is a continued growth in gold in the form of investment. And I think that that's where we're starting to see it picking up. Financial instruments like exchange traded funds, there's over 14 instruments that are available for people, but gold in that context is getting a lot of attention. So yes, higher prices, slowdown in jewelry, but gravitating, like you've seen in China, towards more of an investment. The question will be, will that demand in investment pick up enough to offset the slowdown that we might be seeing in terms of the pure consumption on jewelry? So demand up, I think it's up 46%. Expect it to be a strong number. That lowering of that tariff could be good not only for jewelry, but again, continuing to support the investment market for India.
Yeah, interesting, protection on the portfolio there too. Okay, we talked about the central banks. Obviously, we have the upcoming FOMC meeting. Some analysts are suggesting that the Fed needs to start cutting rates now. Others predicting by September they're going to start. How do you see these potential rate cuts, which it seems like the market's pricing in, influence gold demand and prices here?
Well, if investors speak with their dollars, the signal we're getting both in the European ETF space and the U.S. space is that they're thinking more than ever before, and I know we've had this conversation, that the rate cuts are likely to happen. This meeting, followed more importantly by September, will be when the rate cuts look to manifest themselves and come to life. That catalyst will be when the Western investor comes back to the market. They'll be looking at the value of holding gold in their portfolio. They'll be looking at bringing the money to market. Europe actually moved earlier than the U.S. market did when it comes to analyzing this behavior through ETF flows. Europe's almost up $3 billion in terms of flows that have changed from a negative number that was quite substantial. And you actually can see an ECB rate cut of 25 basis points, an interesting development around a French election, and debt concerns, and the ability for the European market to continue to sustain those levels of growth with debt. It's likely driving people back to the gold market for that diversifier into their portfolio. The alternative, the opportunity cost away, is becoming less appealing, gold becoming more appealing. Now that's going to play out, but look, this week could change everything depending on how the FOMC meeting comes out. Let's take a look. We've tried to predict this in the past and look where we are today. Our expectation, though, is that there's a very, very likely rate cut on the way, and that'll actually lead to investors back to the table.
Yeah, interesting. I mean, you just talked a little bit about those ETF flows coming back in the European market. Is that then what we're expecting with the U.S.? I mean, we're looking at this ballots to bullion report that you put out, and it suggests that historically U.S. elections haven't significantly impacted gold prices directly. However, we got Biden stepping down. There's a tight race between Harris and Trump. Could this election cycle be different? I mean, what factors could make this election an exception here?
Well, a lot of factors are already making it different. But what we would say is it's going to add an exciting element to the gold market, and it likely will manifest itself in more volatility in the gold price. Probably won't be a huge determinant of gold flows as of late. I think the rate cut, the rate environment will likely be what will be driving the Western investor back to the market. And actually, while they are less flows positive for the US ETF space versus Europe over the last several months, the trend is moving in that direction. The one thing we'd qualify, though, again, gold is a large asset. It's a very liquid asset. It's very easy for that market to be speculated. So again, expect some choppiness in the price, but ultimately, this is the case for when Western investors will come back to the table. They need to see those true signs of that rate cut coming. Now, this week will be a real telling sign for us. Let's see how the meetings go and what we get in terms of a signal. But again, investors speaking with their dollars are already giving us the indication that that's the direction they're heading.
Yeah, I wonder, given the unprecedented fiscal stimulus during COVID-19 pandemic, we get the geopolitical tensions happening right now around the globe. Could we be underestimating the potential for this election to be a major turning point for gold prices? I mean, is the market prepared for a more dramatic response here? What if that happens?
Well, I think that the potential for a dramatic outcome in the election, very high. I think ultimately, as it relates to the gold market, again, it'll be the speed with which the markets can read, expect, and interpret, and then turn that into impact for gold when it comes to the policies that'll be stated by either party who wins the election. And I think that's really what our report highlights is let's not get too caught up short term over whether or not bar and coin demand in the US will rise because of a tax and spend reaction from a Democratic win or something more focused on, a bring it all home Republican kind of mentality. I think more important than anything is the fact that the market's going to react, but it's going to do so as it relates to policy that's foreign policy oriented, geopolitical oriented, but also, like you've highlighted, this issue of fiscal challenge in the U.S. is substantial. Fiscal challenge in the U.S., that plus increased cost of debt for corporates, credit risks that are embedded in the system. There's a lot that could basically shock the system. And I think that could be, in addition to this catalyst of rate cut, it could be one of those moves that moves the market quick. But barring one of those types of moves, I would expect to see the market a bit choppy as people are emotional around the election going into the fall.
Yeah, seems like a lot of people. I mean, there's so much narrative to go through every day. I mean, we talk about it. Joe, this latest report highlighted that there's an increase in U.S. gold bar and coin demand, as you just mentioned, during Democratic presidencies, which I find quite interesting. Explain why this trend exists and how this might play out if, say, a Kamala Harris potentially takes the lead here.
Well, I think it's a sign that most investors that are actually thinking about how the financial market ecosystem in the U.S. is going to play out, a tax and spend environment is one where people are very comfortable with it. And I think that it puts pressure on the financial markets and the financial system. The idea of them having physical possession of their asset, their ability to hold on to their asset in a depreciating environment, quite strong. And I think that that's what drives those investment dollars to those types of financial instruments. But what's also kind of interesting is even throughout the last 3 years, what we've been seeing are moments that have actually pushed foreign coin demand up: bank failures, invasions, conflicts around the globe, and it actually tends to be a bit emotional in terms of the flows. That has been coupled with steady and ongoing interest on the part of investors and consumers, I should say, for the foreign coin market. And that's been highlighted by new channels that have been opened up through Costco and others that are actually saying, hey, look, we know that there's ongoing steady demand for it. It's a question of whether it's material and substantial or reacting to a bigger moment. And I think that what we'll probably see between now and the time of the election, stable flow, kind of a quiet environment for foreign coin. After the election, maybe a reaction. And we'll see after we see how it goes in November.
Yeah, of course. Lots to be watching out for. You talked a little bit there about banks. Obviously, not in the best situation. We're starting to see some cracks in the U.S. economy with the latest numbers. Not to mention the U.S.'s debt. But according to the Balance and Bullion report, it was interesting because there's a 100 basis point rise in the geopolitical risk index has a 2.5% positive impact on gold's return. I mean, that was a kind of an interesting fact that I thought. So with the current geopolitical risks going on globally, and we aren't seeing a slowdown, especially with Israel vowing retaliation after the Golan Heights strike, how should investors interpret these indicators to gold prices as we watch in this narrative-rich environment?
Yeah, I think what that report is going to highlight and what we talk to when it comes to that impact from move, that talks to the tactical investor and tactical behavior of the investor in the market. So those types of spikes in those numbers tend to happen right in the aftermath of that geopolitical event. But then we calm down and things go back to understanding and maybe getting a much more comprehensive perspective on exactly what the geopolitical event is going to mean and how policy from those that are needing to step in, whether it's the West or others, how they're going to change their behavior and how they're going to help either aid to resolve the conflict or not. The reality is, again, that number is a spike number. It usually happens in the aftermath. Happened after we had a banking crisis, happened after the Israeli-Gaza conflict, and also for sure after the Russian invasion of Ukraine. So again, watching for those moments, those are going to be tactical movers of the price, and they're going to actually have that spiking impact potentially. And we continue to want to make sure that investors understand that behind all of this are the bigger moves, growth of economies, the growth, wealth, and actually the growth of savings and the protection of wealth. And that's the bigger strategic driver behind the price of gold.
Yeah, interesting. I mean, you can definitely see by the numbers, people are starting to pay attention. Okay, well, this brings me to the U.S. China trade tensions. I mean, how is this going to affect, if we get Trump into the White House? It seems like there's going to be some aggressive trade talks taking place. Are you keeping an eye on anything like these types as opposed to just the geopolitics of things?
Well, I think that trade discussion with China is going to be a very interesting factor, probably in terms of how it plays out for strength of the U.S. dollar and overall how it's going to play out for the economy onshore. I think at this stage, what we'd say is that's a very, very challenging environment to unpack. And we'd say we need to see where we land in terms of an overall play with respect to the election. But what is very clear is the Republican ticket has made it very clear that they are quite concerned around the relationship with China. And in the past, what we've seen is the demand for China to look at gold as a diversifier that they've added to the portfolio at the central bank level. So it could mean that onshore in the U.S. may not necessarily a need for an increase in gold in your holdings, but it might mean that we see more demand offshore for gold than we do onshore.
Yeah. Okay. Well, considering the potential for significant fiscal policy changes, which we're seeing from both parties, there's tax reforms, infrastructure spending. I got to play the devil's advocate. I mean, could we see a scenario where gold prices skyrocket if these policies lead to higher inflation?
Yes, is the short answer to that question. I think that everyone is watching with bated breath in terms of how the fiscal challenges in the U.S. get dealt with. And we're not alone in terms of an asset that's going to be potentially an alternative to the dollar, potentially the safe haven where you want to add to your reserve of your own personal investment portfolio. And ultimately, there's a lot at play in terms of how the U.S. is going to deal with the debt service alone that it's challenged with. And for us, what we see, again, this is part of a bigger picture that we see a strong case for the consumption of gold and a lot of very challenging problems ahead of us in terms of how to get out of the picture. So in a higher inflationary environment for us would be an environment that would be strong for gold. It would be one that's higher and stickier, where gold would actually show its wealth in terms of its value in a portfolio versus a transient time of inflation. But for us, we see the outcomes and the outlook for gold reasonably strong across the board.
Yeah. In the conversations that you're having, Joe, I mean, are people losing confidence in the U.S. dollar and this demand for gold is going to continue to rise here? Is that really what's kind of taking place as we talk about the fiscal challenge, the debt levels, and then, of course, the high interest rates?
Well, I think what we're seeing and part of what is embedded in some of the messaging from central banks overseas is the fact that they're looking for the right kind of a diversifier to their portfolio, where they might have found it in the form of a treasury or a bill in the past, where they think they're looking for things that will preserve their asset value and perform. And I think that there's quite some concern around how that asset mix of U.S. dollar, U.S. assets will play out in the central bank community. So there's definitely an increased level of interest from central banks to diversify an asset that will do what you need it to do, perform that role of a shock absorber in your portfolio. And that's what gold can do without being coupled to the dollar or coupled to U.S. policy. And actually, I think it's going to be a strong continued investment vehicle for emerging market central banks.
Yeah, it's fascinating to watch. Okay, last one, because I know you're a busy guy and it's a beautiful day in New York, I'm sure. But the balance to bullion report mentioned that the U.S. now has a 10% twin deficit, worse than during the peak of the tech bust and not far from the depths of the global financial crisis. Just on your macro take here, how do you see this playing out, really, here? How's this going to work for us?
Well, look, I'm far from an economist that can actually call how this is going to play out, but there's really just one big signal ahead of us, and that is really just a weakness in the dollar that has to be basically taken into consideration. And I think that that's been on the minds of many people, and I think that that's going to be a likely scenario that's going to be watched carefully to see how it plays out in terms of the dollar strength and just kind of losing purchasing power from the dollar is probably a likely scenario for how the U.S. is going to get itself out of this continuing problem that it's got.
My goodness. Well said. Well, we'll continue to watch that. Obviously have the latest here with Jerome Powell and seeing what they're all up to. Joe Cavatoni from the World Gold Council joining us today. Thanks again for making the time. Love the reports. Fantastic insight, Joe.
Thanks very much.
Appreciate it. I'm Jeremy Szafron. For all of us here at Kitco News, thank you for watching. We got lots of great content to come. Make sure to hit that notification button to stay in the know, and we'll see you next time.